Yesterday, the US dollar was actually going down. Gold was actually almost, hitting the record high. Silver was printing, and the US equities market was also green. But today, the silver, gold, they are really, really down, and I'm gonna show you what has been happening in those commodities markets. And also, if I look at most of the tech stocks in the US, they have been on a downtrend. So, what is the catalyst that has been causing that? I think from what I've been observing on the news on Bloomberg and also using my own analysis, President Trump announced that there's a nominee for the FOMC, Governor Walsh, and that's something that probably routed the market. And what you can see here is that a lot of money has moved from the gold, silver, and it has gone back to the US dollar. Maybe it probably suggested that um, traders and investors, they have confidence in the US Federal Reserve again. So that's something that I closely monitor. But what I've observed over the past couple of years is that I try not to predict the markets because there are a lot of unknown variables. But what I'm just going to show you is my analysis, technical analysis to be precise, on gold, DXY, which is the US dollar relative to other baskets of other currencies. Because what happens is people with money, they are always thinking of moving their money to where they can make the most, whether it's from the Eurozone, Australia, Japan. So all those moves, I watch those moves and try to interpret them. And whatever I say on this is not supposed to be taken as investment advice, because investing is personal. In a way, you have to do what is good for you. I like to always have an emergency fund. I don't want to be selling and panic selling because I want money to pay for bills. So the most important thing is to understand the things that you do. If you haven't subscribed on this channel, make sure you subscribe. I'm gonna be from time to time doing these regular commentary on what I'm seeing on the markets and just telling you what I think. So let's get started. The first thing is that a lot of people, they ask me, like, how do I play gold? I mean, there are a couple of ways to go about it. I know for me, I can play gold using exchange traded funds, and the one exchange traded fund, basically you are looking at these funds that usually mimic the actual index. In this case, this is the gold. And what this does is that, it allows you to buy the shares, and it mimics what's happening on the gold, but you have to pay a small fee. So what I do is I play this gold. If I to play gold and I haven't taken a trade on this, is I like to do technical analysis. This is the what we call the Bollinger Band, and this is a 1 day chart. And in other words, with this one candle, it shows you what happened in that 1 day. It means gold, it went as high as $468.65, and it went as low as that was here, let's just say $431.97. But at the end of the day, you can see that it closed at this level, right? So what this means is that there are a couple of things to consider here. Before I take a trade, I want to see favorable conditions. For me, I like to be taking trades because this is a demand zone. I use an app here called Luxo Algo to it just draws for me the demand zone and the supply zone. Demand zone, these are basically levels where huge fund managers or people with money, they place buy orders at these levels. And what this does is that if there are more buyers who take control, the prices are most likely going to go back. Like you see here, there were more sellers. This is a supply zone, right? And it means if they were in control, like they were as a sell-off, it means these people with money, they were selling a lot of these of the gold, and probably they were just taking profits. And today they continued doing that, you know. And what this does is that a lot of people who just jump in, they panic, and once they sell, then it means that that commodity probably drops. So in this case, if I was to play gold, I wouldn't just jump in right now. Once I see a commodity extended at the outside part of the Bollinger Band, it means it's oversold, it's overbought, right? So what people do is they actually sell and take some profit. So I like to buy at this point, right? At the bottom of the Bollinger Band, right? Around this level. So if it was to come at this level, because it's very difficult to time the market. So what I would do is I would take a cash secured put. Let's say this ETF, it comes to this level, or even this level, right, of 395, 396. But if I'm to be patient, which is very important, by the way, I would wait for it to come to this. If it doesn't, I will play other stocks that are actually, suiting my checklist. So I would come at this point. So let's say I take a cash secured put. In other words, I would say, okay, I would take, let's say, a delta of minus 0.2, means there's a 80% chance that I will probably be assigned. So let's say I take a strike price, for example. I'm just taking this from the top of my head, but I could see it from my brokerage account. That is where I can buy and sell those shares. So that would be like $336. So if I take it, that strike price of 336, and if the gold was to drop, this ETF to drop from 380 to 336 to 300, and let's say 340, that's okay, I would be assigned. So that means I should have 38,000 US dollars in my account to secure that transaction. But let's say I get paid $800, right? So that's $8 move in that case. So that means if it's 330, effectively my cost basis would be 332. So that's when, if it drops to that level, then I would say, okay, I'm starting to lose money. But once I buy something, I usually want to hold it for the long term. So that would be fine. But the thing is, like, if I'm not assigned, or if I decide to close the position, I would buy to close the position, right? And take the profit. So that's how I trade. So that's how I would play gold. Now, some people would say silver. Silver is more like leveraged gold. You see the way it plummeted. It really dropped from the high, from this week high here. Right now it's at this point. So if I was to just see here, the past 2 days, it has dropped by, you can see here, 31%, right? 31.24% to be precise, right? But you see that it actually dropped at some point to almost this level. So it almost went down like 38% in the past 2 days. And gold, in fact, today, if I look at gold, it just went 9%. You see here it went 28.5%. What does it tell you? It's more like a leverage, because the demand is limited compared to gold. It's kind of like, second fiddle to gold. Some people may buy that. But the way that I play is the same thing. I play through exchange traded funds, right? So if it was to drop at this point, why do I choose this? Because usually, from what I've observed, there's usually about 95% chance that if a stock or a commodity, it has to trade within the Bollinger Band. You can see here, right? It was trading within this. So if I'm able to, if I have a position, I have shares, and it's at this point, I can sell a covered call. Most likely it drops, it means my shares are not going to be taken away. If I have I want to buy cheaply and get paid for that, I would get in at this point. Again, it's very easy to look at it after the fact, right? But I tend to just look at the Bollinger Band. I don't like to be buying or opening positions, in this case, buying at this point, right? I want to be selling covered calls if I have shares at this point, buying, or in this case, selling cash secured puts at this point, right? And that's how I manage risk. Now, a lot of money went back to gold after the Fed nominee was announced. But if I look at the Nasdaq, it has mostly been driven by stocks like Meta, Amazon, which constitutes most of these, the index. So if I wanted to play it, I would do QQQ, that is the ticker name, but it mimics pretty much what happens with the Nasdaq index because I can't buy into the index. I just do it through what are called exchange traded funds. So you can see here it follows pretty much the same pattern. But you can see that if you look at it from April last year, it has been going up and up and up. Again, the past 3 days, it has been dropping. So if I had a lot of money, like you see here, this is like 62,187 if you wanted to buy 100 shares. But what I do is I would do a cash secured put if I wanted to buy this. But again, I want to wait for it to come to the demand zone. Again, these are just the technicals. It's not guaranteed, right? And but what I've observed is that each time that I'm patient, I wait for whatever I usually play individual stocks for it to come down to this level. I have been successful in terms of like locking in some profits. Like today, I quickly played UNH, UnitedHealth. It actually dropped after their earnings. Not after their earnings, but there was a US policy that they wanted to charge, I think, 0.9 cents on the insurance premiums. And you see Humana, UNH, they provide insurance. Yeah, health is something that is elastic when you talk about elasticity. In other words, because you are sick, you still need that healthcare. So I think they continue to make money. But what I do is I like to play it because you see it's right at the bottom of the Bollinger Band, right? So I like to look at it this way, right? If I get in at this point, it's most likely going to come back. This is a demand zone, supply zone. But most likely this stock, if it is to continue to go down, which again nobody can really tell with certainty, right? It will probably come to this point. So what I do is I take a strike price that is below here, like I did play 275. It's at 286. So it's like I'm playing, getting in the contracts to get in. It's for 275, but at a current price. So I get paid for that. And once it went up for a little bit, I exited. I locked in the profit. It's a small profit, but the thing is, if I have, let's say, 4 or 5 contracts, then if I make $500 or $1,000, that's it, right? I move on to another stock that is at the bottom of the Bollinger Band. But almost most of the stocks that I follow here, these are stocks that I believe they are very good stocks, they fundamentals, and I would like to play them. So that's how I trade. And I hope this technical analysis did give you an insight on how I trade, what I think in the market. But to wrap up, the equities market, the US equities market has been really going up. If you look at the Nasdaq, S&P 500, the past 3 years they've been giving double digits, like 20 over 20%. Last year it was, I think, the S&P 500 returned about over 15%. I think it was 17% or so, right? And 17.6%. Don't quote me for this, but what that means is that if you had your money, you would have gotten that return, right? The past year, that was in 2024, I think it was above 20%. The other year, it was 23%. Why is this happening? It was mostly driven by the tech firms like Amazon, Meta. These companies have been making profits. Their earnings have been, they have been generating more and more profits. So, and including Google as well, Nvidia as well. So these tech firms have been driving these indices up. But it doesn't mean that there are other stocks that haven't been losing money. So that's why it's very difficult to just do individual stocks, because If you were not invested in those stocks like Palantir, Nvidia, Amazon, Google that really went up, you are more likely going, like I heard other people that I saw last year, they actually lost money in a bull market. So the easiest way, like I always tell clients, this is not investment advice, is that of course you have to look at your individual circumstances. I just buy into the index fund. Like for example, for my son, I am investing for his education fund. I just bought index funds, right? I just bought 10 shares today, it's down. I'm just buying it for the long term, right? But the key thing is to just focus on things that I understand. I monitor the market, but for index funds, usually they tend to go up over the long term. But there are years that it might probably go down. Is there someone who really knows? I really don't know. The markets can really go in any direction. How do I do that? I do probabilities, right? I just look at the analysis, fundamentals. If I'm comfortable with it, I can take cash secured puts. I don't do naked options anymore. And I just repeat that. And it turns out I've been profitable and I have been learning along the way. And it doesn't guarantee that I will be profitable in the future, but at least that has been working, right? And it's very interesting, right? Because once I started making less trades, just being patient, sometimes in a week I do 2 3 trades. I take those positions, and I have very few stocks that I follow. It has been a game changer, at least for now, right? And I'm focusing on sectors that are really interesting, like I playing AI chips, but there are some companies that have been really overvalued, like Palantir has been overvalued. I've been seeing stocks like Seagate, Celestica, and I actually have a cash secured put. I don't know what's going to happen, but on Monday, if it continues to go down, still, the good thing about cash secured puts is I buy stocks, I sell cash secured puts on stocks that I otherwise want to own the shares, right? So if on Monday it goes down, it goes up, the key thing is if it doesn't hit my strike price, still I will probably collect even almost all um, the premium that I will have gotten. But usually I like to take profits once I see them. So if you want to learn more about this, make sure you subscribe. You can book a one-on-one coaching on www.streetwiseeconomics. Thank you so much for tuning in, and I'll see you on the next commentary. Tell me how you are seeing this market. How are you making money? I have shifted from being an options buyer to an options seller. That's what I do pretty much on stocks that I understand I otherwise want to own. And I've been hesitant to just play and chase, like commodities like silver, gold. But if they come to the right levels, like I showed you, I could probably do that just to hedge the portfolio. But again, the most important thing is to manage risk. And I like to have a bit of cash actually to be able to maneuver and to take advantage if the market